Thank you for joining iMeet. When you hear the tone, you will be the 11th person to join the meeting.
Hey everybody, good afternoon. This is David Blake. This is Tuesday Tech Talk, and we're going to quickly review the last couple of days and try to figure out what the market's going to do here after the election plays out. And then we'll talk about 20-25 minutes, and then we'll open it up for questions and have a discussion. Try to keep this thing around 30 minutes. I want to start out and apologize for the last week or so with our updates, our nightly updates and our charts. As most of you know, we moved our offices, and when you tear down networks and about 50 computers and move them across town, I'm actually shocked that anything works at all. But part of the reason for the move is that we're in the process of rolling out a new site, hopefully by year's end, with a lot of new features and charts, moving everything up to the cloud, and I think everyone will be pleased with the new developments. The tech crew has been working really hard, and the changes that they've had to make are solid, and I think they'll help with your investment process going forward. 2 weeks ago, we had a problem with the presentation, and I got a lot of phone calls to go over some of the things that we talked about, and I'm going to do that and talk a little bit about the CTI, because we are still going through a lot of changes in here, and I want to make sure you're up to date with especially with the leveraged ETFs that we have and all that kind of stuff. So what we're going to talk about first is we flipped the CTI to a positive +2 the week ending 10/21, October 21st, and we closed out our leveraged triple short index funds. We went short the ETFs on September 2nd when the Dow was at 18,491.96. We covered and went long Friday when the Dow was at 18,145.71. That was on the 21st of October. So we picked up about 346 points on that play with the leveraged ETFs. Okay, as of last Friday, counting yesterday, the Dow Jones was up year to date about 463 points, or 2.7%. And if you had timed the market with our CTI, not leverage, just regular CTI picks, you had picked up 2,419 points, and that was good for 13.9%. So we're again doing quite better than the actual Dow itself. Now, in 2015, if you're not familiar with the CTI, the Dow was down about 2.2%, where if you worked at the CTI, you're up 18.22%. And I'm going to show you actually the calls over the last couple years, so you can see on the last chart today. But if you've gone long, short, to triple leverage ETFs year to date, we're up about 45, 46%, and that's what we're going to talk about. Now, what we closed out when we went short in September are these four ETFs right here. Now, this is the SDOW, which was we closed it out at 13.55. We picked up 3 3/4%. SPXS, we closed up at 12.65, made 3.5%. The NASDAQ outperformed. We actually lost 4.8% on that one, but luckily we picked up 5.5% on the Russell 2000. That's why I like to buy all four of them rather than just depend on one index, because you're going to get some moves. For instance, over the summer, I think we picked up about 20-some% over on the Russell 2000 just from the May call. So what we wanted to do is I did tell you on the market letter that the leveraged ETFs that we had were going long. This call you didn't necessarily have to go into it, mainly because the CTI is only scheduled to stay long for about 3 or 4 weeks. But if you were going to go with them back on the 21st, you would have bought the 24th, you'd have bought the UDOW, which is the long triple leverage ETF, SPXL, TQQQ, and URTY. These were the prices that we bought. And the way we do this, just for discipline, we close them and buy them on the same day at 4 o'clock on Friday. Okay, so these are the ones that you would have bought. Again, in this case, if you've been reading the Friday market letter, rather than tell you that for this long call, rather than going in and buying a bunch of stocks and loading up the guns, I thought since it was such a short period that I'd have recommended probably scaling out of positions when we get a kind of a relief rally from the election. So let's take a look at some of the stuff that we're doing right here. Well, actually, just going over last week, you know, it was pretty ugly. We had the S&P 500 holding on to a 9-day slide that ended right at its 200-day moving average, which I'll show you in just a minute. Let's take a look over here. Over here was last Friday. You can see this is the 200-day moving average. So that 9 days straight down was, you know, caught support here, and then we bounced off of it yesterday and had quite a relief rally, which was, you know, kind of expected because all the indicators down here were very oversold. Every sector finished in the red last week. They were led by technology, energy, consumer staples, and healthcare. They were the biggest drags in the broader market. Small cap stocks underperformed, and actually going into last Friday, the industry group medical biotech was off 8.5%. So that shows you that's quite a big move, almost for a correction in that. The technical indicators deteriorated. The stochastics and 14-day RSI were both at oversold levels for most of the indexes. However, like I said, all the major indexes were able to stop the bloodshed just above their respective 200-day moving average, which was a positive. Now, the market breadth was very bearish. And we're going to look at the AD lines for both the NYSE and NASDAQ in a minute here, and also the 52-week new lows topped the 52-week highs on both exchanges. And we saw quite a bit of negative divergence between those two indicators, which I believe are leading indicators for what the market's going to do. We also saw, especially the NASDAQ, the new 52-week lows hitting triple digits throughout and expanding over the last week and a half or so. So as we wrapped up last Friday, we always said, barring any Trump victory, there's a lot of indications that the worst was probably behind us over the short term. We gave the reasons that the rotation that we had talked about earlier, of moving out of the defensive sectors and into the growth sectors, seemed to be holding up. The technology, materials, industrials, financials, and energy were all able to stay above their 200-day moving average during the last sell-off here. And the interest-sensitive sectors, utilities, consumer staples, and telecommunications, they actually fell below the 200-day and remained that way. Also, the healthcare sector was below its 200-day too. So, of course, that's been beaten down mainly by a lot of it's because of the Democratic rhetoric on drug pricing. But another thing I liked about this, we've been talking over and over about the Dow Jones Transportation Index and how that actually forecasts a healthy economy better than some of the other indexes. It still remained above its 50-day moving average, and looks like, I said last Friday, it looked like it was about ready to break out of its trading range going back to April. That actually happened yesterday during the relief rally that we got. The first thing we want to look at is we'll look at this at the Dow. You know, yesterday we had quite an unusual day. It had the second biggest day in of the whole year so far. It was on January 29th. We had a 394 point day gain. I guess that would be back. That's only 6 months. So we got above the 50-day and the 100-day. We came down this morning, pulled back, and kind of bounced around that 100-day moving average, 50-day moving average, and then we took off again this afternoon, right before lunch here. The Dow's up another 100 points, another 0.5%, which is good. And we also we broke a long time descending trend line here. We were able to trade above that. So if we're at 18,361, that puts us up to about right here right now, which is getting close to that upper range. Up 18.4, I think, is about the high point of this trading range that we were in for so long. So we want to see if we kind of stall out, not too much higher than where I think we are right now. But you have some short covering in here. This is basically telling you that the market thinks that Clinton's going to win, basically because they don't want to have any uncertainty coming in here. Unfortunately, like I say, we're back in this trading range up to about 18.4. We want to see if at least we can hold above here over the next couple of days or maybe a week or so above this 18.3 and above the 50 and 200-day moving average. Okay, looking over here, here's the, you can see how the AD line for the NYSE had moved over. We lost about almost 10,000 units from the 1st of October into the first week of November. That's negative divergence. It's something that it's telling you that the upside may be limited on even with yesterday's pop. This is really going to have to turn around before it's going to. This is considered a leading indicator, and this isn't pointing to a new high in the Dow. It's possible, but if the Dow makes a new high and this thing only gets up to about this area, that's going to be another negative divergence, which means we'll probably roll over from there. Now, what I do like, about this thing here, right now you're looking at something we talked about before called the OCO, Advanced Decline Line, which is not shown here, but it's operating companies only, and that excludes companies that the people, it excludes the high-yielding preferred stocks and that type of stock in this. So the OCO line, if you can get a chance to see that, you'll see that it's actually outperforming right in this area here, and that's actually a little bit bullish. But for right now, we're seeing the negative divergence on the AD line. You want to watch that. Another sign of that we're seeing negative divergence. This is you can see the new 52-week lows. We're outperforming the 52-week highs over here. That's not a sign of strength. And we got a reversal yesterday. We'll probably get a little bit more of that today, but you want to see if that can remain for the NYSE. But this is negative divergence and says that our upside at this stage may be a little bit limited at this point. Okay, here's the S&P 500. Looks a lot like the Dow. However, you can see right here, we didn't make it up even up to the 100-day moving average. And you're getting also a crossover from the 50 moving average, which is pointing down, now going through that. Then, of course, you have this descending trend line, which we're below also. But we have the 2143, which is just below this 100-day moving average today. I don't think you'll get any higher than this about 2160, to tell you the truth, which would be right about this, right around where the 50 is and this descending trend line. I would think that would be about where this would top out. You were very oversold, as you see down here on the indicators, had a nice bounce. But as far as the intermediate term trend, you didn't get much of a reaction on that from one day. You get a little bit of a pickup here with today's action. But this certainly is a far cry from signaling a buy back into the market. So I wouldn't get real excited about this. This is an oversold relief rally at this stage. Okay, here's the NASDAQ. As you can see, it was holding up quite well until 2 weeks ago, once we got that news on the Clinton emails and all. It also descended pretty quickly, broke through the 50-day, broke through the 100-day. Didn't quite get down to the 200, but we bounced yesterday and we were able to climb above the 100, which is good. Today we're at 5,200, which is over here. So we still got a ways to go to get back up to this old trend line support, and also to get back up to the 50-day. I would think we want to keep an eye on that over the next day or two to see if it can break through that. If it doesn't, that'll signal again lower highs and also lower lows. So keep an eye on that. That's a red flag. Now, back last December when we went to a sell in the market when it was pushing the new highs, one of the things that we didn't like, we saw the AD line declining. And we were also seeing, we were telling you that the only thing we really see going up strongly is the FANG stocks. Well, part of this here, the FANG stocks were rolling over, and we also saw a big collapse in the small cap stocks too. So a lot of red flags with that. Again, like I say, we'll get an oversold relief rally here on the election, hoping that Clinton wins. If she doesn't, I would expect to see at least a 5 or 6% downfall in this. That could take you down maybe to the 200 on NASDAQ. You might get a chance to come down if it breaks. You might get a chance to go down here and maybe retrace about 50% of this whole move, which again would be right around 4,900, 4,800, this area right in here. Again, here's the AD line for the NASDAQ. And this looks horrible. You've lost 10, 11, 12,000 units over the last month. It's almost back down to where it was coming around out of the Brexit vote. So again, this is negative divergence. With the market, that index has fallen down, but you get a little bit of a line here. You're going to have a descending trend line here. You've got a lot of work to do on the NASDAQ as far as the distribution goes in the stocks before you're going to see anything like it's put in a bottom. I wouldn't call that a sign of strength. And here was the new 52-week lows, expanding all the way through this period. We had a couple of days here where it started to tighten up. You still, even with yesterday's rally, you had more new lows and new highs. But I think today we'll probably get this should cross over for a little bit. But again, this is negative divergence for the NASDAQ that you don't want to. It is a red flag, this thing. All right, I wanted to take a look real quickly at the Philadelphia Semi-Index, because that was close to making a new high, which is good if you want to see what's going to lead the market higher. We broke below support of this rising trend line over here. Then we bounced up yesterday right into the support area. We are a little bit higher on the semis today, not a lot. So I don't think you've taken out this area yet. You want to see that at least take out, but you were oversold down here in the stochastic. It bounced off of that. But also in the MACD long term, that one-day move has not changed this, where right over in here you kind of look bearish. And this is an intermediate term, like going out maybe 30, 60 days, 90 days maybe, and that's still bearish. So this is going to have to take out that high before you're going to see some positive divergence on that. But the last thing I want to show you before we go a little bit more of the CTI, this is Dow Jones Transportation Index, which I keep telling you this probably holds the key to what can happen. Now going back, you see this area that would come up here, hit that, roll over, get close, roll over, get close, roll over, bounce off a couple times, roll over, and finally we broke out. We had a big day yesterday. It was up almost 3%, or actually it was up 3%. We were able to hold a 50-day and trend line, or 50 days moving average going back here. You're getting nice movement in the technical indicators. The MACD long term is still kind of it's been flat, which we expect through this. But if this can advance higher, you might start to see a little pickup in that. Now it's down about 30 points today, but that's all related to earnings miss and a cut in forecast from Hertz, which is part of the Dow Jones Transport. So you had a nice. That's what's causing the pullback today. But if this thing can lead the market going forward, that's what you want to see. That could mean that we could get a couple, maybe a week or two more of an advancing market, and that would help the broader market hold on to the gains. If this thing comes up here as a failed breakout, that's going to be another negative for the broader market. So just keep an eye on the Dow Jones Transports. And here you can see it over on the shorter term. If you look at this, you start to see a pattern of higher lows and higher highs. So we've got that. It's going to have to come down here below about 7,700, or actually about 7,800 before we start to see a breakup of that. But this is a sign of strength for you, and I think as long as we can stay above this, above the breakout range, that's a positive going forward for the broader market. Okay, for those who joined me 2 weeks ago and we talked about the CTI, I have a couple of new charts I want to show you that we want to look at. But just to talk about the CTI, it's our proprietary index. It's called the Cyclical Trend Index. It's comprised of 5 different cycles: A, B, C, D, and E. And what they do is they move in synchronicity, and they move in patterns. So when one peaks, you'll see the other one's peaking, and they bottom together. You want to see this? What we try to use these for the forecasting market directions based on studies that demonstrate that stocks tend to experience price reversals and at anticipated time intervals based on kind of a 4-year business cycle. And what we try to do is with the cycle to set highs and lows in the Dow Jones during these time periods. They're going to show that they'll move in synchronicity, and also they move in harmony, like we say. When one's topping, the other one's topping, and a third one will be on the way up while these are topping. And it causes different numbers for the different cycles that we put in. I assign numerical values to each one of the cycles as they progress along their time period. And then we take those values and calculate them into a round number. And depending on where we are in the long-term cycle, the shorter cycles receive higher values because they're going to be more dominant during that time period. So CTI, unlike the second opinion, which you get, when you look up a stock, that is a trend following method. And it's basically look at the moving averages and a lot of other indicators that try to keep you in a trend. And when the trend reverses, the second opinion will try to get you out. When the market's trending, it works great. When the market's going in a sideways fashion, you're going to get more whipsaws in the second opinion because it's trend following in a trading pattern. Just when the stock will get up to the high, where the trend's ready to begin, it'll reverse, and you'll find out that it's in a trading pattern. That's a little tough to trade sometimes. But anyway, what I wanted to talk about a little bit today is where we are with the CTI right now. This is kind of something I just did today. It didn't come out very well for some reason. I think it's because I used a different expansion on the charts that I put up. But right now we're on the buy signal, which where we went to right over here. And this was a +2. And the reason there's a little bit of a hesitation on my part right now, where I'm telling you just the way I thought that rather than go along the CTI, you may just want to hold this one out and wait till we go to the next sell, is because back in May, which was right over here, the market bottomed here, and then we went a couple more weeks. We went to a buy. Well, then the Brexit vote came along. We made another low. Now, normally we can look at that and we can say, okay, well that means we needed to expand the original cycle out 3 weeks here, or 4 weeks, and then start the counts over there. But we were actually, it reversed so fast that I thought, okay, well that's an evolution here. What we'll try to do is we'll go ahead and do 2 counts and work off of that. So using this one here off the May, we stayed long all the way into went to a sell on September 2nd over here. During that time period, we picked up 618 points from this one here up to the where we went to sell on 9/2. We sold it, went short at 18,491 on the Dow. Okay, then we stayed short over to here, and it went down, but then it kind of came back kind of quickly again, and we went to a buy on 10/21. This 10/21? No, this was the 9 over here. I'm sorry. So this is where we went to the short, and we went short over here, and then started to come back here, and we picked up from the 9/2 to the 10/21. We went short at 18,491, and then we went long again at 10/21 at 18,145. So we picked up 346 points on the Dow. Now, if I had moved the CTI over to the Brexit bottom, I'm probably getting a little bit too far into this at this stage, but I just hope you can bear with me a little bit. That would have extended this sell out to about here. So we would have gone short here, and we'd have still been, of course, we'd still be short now. We'd be getting hit. But I decided that we went short over from here, and we went long on this. Now, with the Brexit vote, we would be going long at the end of this coming week, which actually would be up here. So with the problem, what it means is we're going to go to so we're going to buy actually on both of these. So they're going to come back into sync. Now the problem is over the next 2 or 3 weeks, both of the models, whichever way we will play it, it goes to a sell on both models, and that'll get them back into sync. And both models do not go back to a buy until we get into right around maybe early January, first to the end of the year, something like that. So that to me is going to negate. We'll get this relief rally from the election. The market hates uncertainty. That's what Donald Trump brings to the market. And I'm not sure the market's going to just love Hillary, but it does love the fact that it's going to they know what to expect with Hillary. But at this stage, we're probably going to get ready here to go to a sell in the market probably the next 2 or 3 weeks. And at that stage, I think you can go buy those leveraged triple leveraged ETFs to the short side and probably get a good 4, 5, 6 week play out of that. That also coincides with the beginning of when we begin to ramp up the interest rates I think that's probably going to figure into that sometime, despite people saying that the market's already priced in a December rate hike. The traders don't like a rate hike anyway, and I think you're still going to probably have some volatility moving in right around that time. Even though seasonally it's a pretty strong time, that may limit some of the downside, but I don't think you're going to see much upside after the next week or so. So that's where we are with the CTI count. Again, I'm discounting a move, end of the year rally. I would be very cautious on this thing when we get some rallies like today. I think you start looking at some holdings that you have that you may want to reposition, come out of some, and go to some of the stuff that's still strong. Hold on to it and get your sell stops ready, and have an exit strategy where you want to go ahead and cut bait on some of the stuff that you're going to ride higher on this relief rally. That's about all I have for right now. I'm going to open it up to questions. We've gone almost 30 minutes. Let's see. I don't see any questions coming in at this time. Does anyone have anything? Okay. We'll be back next week to talk about where the market's going. We'll talk about the different sectors, where we think of what's weakening, what's outperforming. Again, we'll talk about the transports. We also had a heck of a move in the Russell yesterday. We'd like to see the small caps participate in this, and we'll talk to you next week. We'll get a thing again. I apologize about the webinar 2 weeks ago when it didn't lock in the PowerPoint presentation. I think we all have that fixed. As far as our updates and charts go now, I think we're in good shape. I hope we don't have any more updating problems going forward. So we'll talk to you next week. Thanks for joining me.